Assalamualaikum and hello everyone. First and foremost, we are the students in group B824D. So, in this video, we would like to present a current issue for our group assignment. The issue is about the performance of Islamic mutual funds and why it is not better than conventional. Basically, mutual funds are a subset of the capital market that is a collective investment and consists of many securities that are pulled from investors. For example, equity funds, bond funds, index funds, and many more. Next is the differences between Islamic and conventional mutual funds. For Islamic mutual funds, they deal in tangible asset, relationship known as partnership, agency, lessor-lessee. The financier and client will bear the risk, and it is governed by divine law and ethical guidelines, and lastly has many contractual conditions. Meanwhile, for conventional, they deal in intangible assets, the relationship known as borrower, lender, and only client will bear the risk, and it is not governed by divine law, and lastly do not has many contractual conditions. According to the Security Commissions, Malaysia has one of the highest numbers of Islamic mutual funds in the world, with 715 Sharia-compliant securities in 2020. Other countries, on the other hand, continue to have smaller numbers. According to the Global Finance magazine, the United Arab Emirates 8%, Kuwait 6%, Qatar 6%, Turkey 2.6%, Bangladesh 2.1%, Indonesia 2%, Bahrain 1.8% out of the world's Sharia-compliant assets.
In this article, we focus on issue of Islamic mutual funds performance compared to conventional mutual funds. Talking about performance of Islamic mutual funds, even though the growth of the market of Islamic mutual fund is higher than conventional, the return is less and the risk is higher than conventional mutual funds. It could be portrayed from the number of alpha and beta, which were totally higher than conventional risk. The causes of poor performance in Islamic mutual fund is unskilled manager, because the manager does not have many choices in making portfolio aligned with the Sharia due to limited available securities in Islamic funds market. Mutual fund will be managed by fund manager of the company, and their role is to make portfolio consisting many securities which will give investors certain amount of returns. Second is incompetence of regulation in government policy in managing Islamic mutual funds. Some government in certain countries make regulation to give burden for foreign investors to invest inside the country. For example, Bahrain Stock Exchange allow GCC citizen to acquire 100% of the company, but foreign investors from non-GCC countries are only allowed to own 49%. This policy has a significant negative impact on economic development inside countries. Because of this policy, the country do not have a high number in Islamic funds and had limited in the ability to develop economy of country. For your information, GCC stands for Gulf Cooperation Council. It is political and economic alliance of 6 Middle Eastern countries such as Saudi Arabia, Kuwait, the United Arab Emirates, Qatar, Bahrain, and Oman.
Next, there are two solutions that can be implemented to solve the issues. The first one is by creating the identity of mutual fund itself. It is because nowadays customers sometimes see that the Islamic and conventional mutual funds as well as the Islamic financial products in general are nearly identical. This is supported by the previous finding from Fakunas in 2018. The complicated practical activity in Islamic banking was the main reason for not doing fully Sharia compliance activities. People choose Islamic products because of the Sharia characteristic. Therefore, the Islamic unit trust product has to make a big difference from the conventional concept. With the world's growing Muslim populations, Islamic mutual funds will have a great opportunity to grow if they can establish their own identity. The second solution is the government from other countries has to promote the Islamic mutual funds to the market. They need to play a vital role in enhancing the Islamic financial industry through policy implementation. the government should open up the market with fewer restrictions. By doing so, it is possible to increase the number of assets and products in the Islamic mutual fund industry. For example, Malaysia, which is known as one of the biggest industry in the mutual fund, use lesser restriction, which means Malaysia's government accept all foreign investment to the country but restrict all local investment to go abroad. As a result, Malaysia's internet Islamic mutual fund industry can develop well. The rapid increase in the number of equity funds can also be seen. Based on the data from Security Commissions in 2020 indicates that 79% of securities in Malaysia are Sharia compliant. Not just that, the government from other countries can also provide regulatory incentive to the companies that attempt to be Sharia compliant, especially in the financial industry, as what Malaysia's government had done to promote the Islamic mutual fund. These solutions can assist in the development of Islamic mutual funds all over the world.
Next is the benefit of investing in Islamic mutual funds is that they are free of prohibited activities like usury, gambling and ambiguity. These sentences are supported by Abdullah 2007. The second point is the return on investment activity gained based on risk and profit sharing, which must be free of interest, gambling and uncertainty. Last advantage is the Sharia committee ensure that the fund manager will commit to provisions match with Sharia compliance products when giving units to investor. The second and the third point are both supported by facts. Fazal Fakrunas 2018. The disadvantage in Islamic mutual funds are many of instrument products that are available to conventional funds are not available to Islamic funds due to difficulties in the interpretation of gharar or called excessive risk. Next, fund managers have some limitations when it comes to selecting stock for their portfolio. This point is supported by from PDF investigation of performance of Malaysian Islamic Unit Trust Fund 2007. The fourth point has a lower return and a larger risk than conventional mutual funds. Lastly, investment profits may not be applied for prohibited activities such as liquor, pornography, or others. Points 3 and 4 are both supported by evidence. Fazal Fakrunas 2018.
Advantages of conventional mutual funds. First is, in conventional mutual funds, all securities in investment is allowed because this kind of fund don't have any restrictions and it opposite to Islamic mutual fund. Next is, conventional mutual funds can freely choose between debt-bearing investment and profit-bearing investments and invest across the spectrum of all available industries. Now, move to the disadvantages of mutual funds. First is, conventional mutual funds emphasize an agreement without any halal or non-halal rules. Besides, there is no term cleaning or cleansing the source of income by separating what is halal and non-halal. The cleansing process means sorting out whether a company has illegitimate income or vice versa in doing its business. Lastly, in conventional mutual funds, profit sharing is made between investors and investment managers are based on interest rate developments. To sum up the issue, incompetent fund managers and ineffective government policy could affect the Islamic mutual funds performance. In our opinion, other countries should follow Malaysia's lead and implement all of the solutions given in order to grow the number of Islamic mutual funds in their own countries. The more Islamic mutual funds, the larger the Islamic capital market will be in the world. So that's all from us, and we hope you learned something from our video. Thank you for watching and bye-bye.
Bye-bye.